Let's talk about ETF volume this week. Normally we talk about flows. Let's look at volume because I do hear this critique a lot. ETFs haven't been tested. So let's look. We had a good data set a week and a half ago when there was all this volatility. Let's see how the ETF trading went, right? So here's a chart of the 5-day rolling average volume, and you can see, boom, when it got volatile, ETFs traded a ton. That's about $1 trillion in a week's time in terms of ETFs trading. So a lot of people trading them, and didn't seem to be any problems, at least in this round. This is par for the course, though. Let's look back at ETF dollar volume historically. And what we find is that to this day, 2008 is still the year they traded the most, $25 trillion worth of shares, and they only had a sixth of the assets. To me, this is when ETFs picked up some new fans, some new investors. They saw what they could do under stress, and they came in. So I think we're looking at that. And also, when you have these periods of volatility, it's also good for these newer, smaller products who are really, really looking for some liquidity to sort of jump up and get in the mainstream. Here are some products that we found saw their 30-day average go way above their 180-day moving average in terms of volume by over 200%. You see some leveraged ETFs here. They always do well in these sort of volatile areas. The infrastructure ETF, PAVE, probably on Trump's spending. You had Spider had two on here because they recently cut fees. Everybody likes cheap ETFs. And then, no shocker here, an ultra-short Dow ETF, again, back to leverage. So not only are these bouts of volatility good for people to see if ETFs are tested, they're good for these smaller products to pick up liquidity, which ultimately leads to assets.
Good stuff, Eric. Let's bring in Dennis Dijkstra. He's the co-CEO of Flow Traders, which is one of the world's most successful algorithmic trading firms and handles about a third of all ETF trades in Europe. And also with us is Bloomberg's Annie Massa, who covers market structure here at Bloomberg. Dennis, let's start with you. It's been a really exciting 2 weeks. What did you learn?
A lot. I think trading and providing liquidity in ETFs is about really understanding the products, managing the risk, and doing what you're there for, just providing liquidity, be on the bid, be on the offer, both on screen, off screen, and managing the risks. Really, let's say, facilitating the in and out flow of these in these products.
And Annie, you've been really on top of Flow Traders and market structure. We saw a ton of volatility. Flow Traders stock, which I'm sure you love, went up 62% in a month based on that volatility. How important is volatility to ETF market makers?
That's right. For electronic traders in general, especially market makers and products like ETF, equities in general, you see a spike in stock price often when volatility spikes because these kinds of traders thrive on volatility. And in the US, there are very few examples of market makers that are public in this way. Flow Traders is one of them. In the US, you have Virtu, and Virtu also saw their stock spike almost 70% so far this year, now that you've been seeing some volatility come back to markets.
Now, we talk about volatility. One of the things that happened during the sell-off was the infamous XIV, rest in peace. We see that XIV,
R.I.P. XIV.
Yeah, it went up or went down 95% in a day. You were on the front lines. I have a question for you. Was part of that, was it extra? Did it go down a little bit extra because of front running? Did people anticipate that Credit Suisse needed to hedge? And is front running in general an issue with ETFs people should be concerned with?
I think front running is not an issue per se. I think there's this direct relationship between the ETF or the ETP and the underlying asset it's supposed to track. I think it has got more to do with small glitches still in the market structure, where as the cash markets close at 4 and the futures and some products are still open, and there can be a lot of, let's say, due to less liquidity. I think that's one where I don't know, swings get exaggerated a bit sometimes.
We've heard here, at least in the U.S., that we've seen retail investors start to go back into these kind of products. Have you noticed something similar?
Yeah, we do still some trading, right? Not per se in these products, but ProShares still have some products out there which cover volatility, and I think that, and to be honest, I think the products did exactly what they were supposed to do, right? So if anything you want to track goes up more than 100% and it's inverse, it should be worth not a lot.
Yeah, Annie, let's talk a little bit about, again, a company like Flow Traders. They're independent, hungry, up and coming. How much did the investment banks miss the whole ETF boom? Because you don't make a lot on the spread when you do ETF trading. People like RFQ, they want their everything cheap. How much did they miss the boat, and can they make it back?
That's right. So investment banks, I think, have seen a little bit of a pullback in market making, in various types of market making, and ETFs is one big one. So they've been a little bit less excited to be in those markets, and you need certain types of sophisticated technology and a business model that's equipped for that, especially after the Volcker rule, for example. Banks have been pulling back in their own proprietary market making. So I think you kind of see that it could be perceived as a missed opportunity for the investment banks. They're losing ground in this area to these scrappier, electronic-driven market-making firms.
Scrappy, you like that?
And Dennis, speaking of scrappy, over in Europe where you have your main operation, MiFID II is a big deal. We've seen that ETF flows in Europe is 58 billion or something to that amount in January. That's an amazing amount of money. How much is this going to move the needle? And are there issues with European investors not being able to buy US ETFs anymore?
Well, I think also coming back to your question about the ETP ecosystem is an open ecosystem. I think, as you said, we just make a very small margin. So it's about scale, it's about technology, and I think MiFID II will bring more transparency, more visibility. In Europe, I think a big issue has been no visibility on especially the off-screen trading of ETPs, because it is to a big extent still an institutional market. So there, having more liquidity visible for investors also attracts more investors and AUM for the issuers, and also having a level playing field. I think that's also very important.
And then let's talk about high frequency trading. That word tends to get a bad rap. Annie, we've seen this is actually could be good for ETFs. Have you seen that actually helps in companies like flow traders who are doing that?
Yeah, basically any company that has extremely sophisticated electronic market-making capabilities can really shine in an area like ETF trading, where you have to have that level of technology to compete in the market.
So just to wrap it all up here, I was talking to some high-level sources at Goldman Sachs, and I was like, okay, what's going to be the next crisis? And one was geopolitical, and the other one was the rise of passive ETFs, that they've never been tested in such a crisis with such amount of flows in them, and that we don't know how they're going to behave, and that's what this individual is really scared about. What would you say to that, Dennis?
I think it's a big debate about active versus passive. If people want to sell, and any asset, right, if you want to get out of a mutual fund, there's going to be selling pressure as well. So I think it's more about the liquidity and having a true open ecosystem. I think that's important, and then I think they will survive, because we've been in 08, 11, 15, I think we've seen many itches, glitches, and volatility spikes, and I think ETFs, to be honest, I think they did very well. Also, with the whole CCP or DTCC being clearing all the trades, so there's not a lot of credit risk involved. I think, as said, the margins due to the market structure of how ETFs are priced, I think it's just very cheap to get in and out, and even as spreads tend to widen a bit if there's a pickup in volatility, I think it's still very efficient to just to gain access to certain risks or get rid of it via ETPs.